In June 2026, Tim Cook stood in front of investors and said something he almost never says. He'd never seen anything like it in any area in over 40 years. He wasn't talking about a new chip breakthrough. He was talking about not being able to get enough memory. That's the world this video sits inside. This is the Micron story, told in two parts. Part 1 is a geopolitical thriller, Micron versus China, and whether a state-backed challenger can actually catch the company that makes the memory inside every AI data center on the planet. Part 2 puts on the equity research hat and asks the harder question. Is Micron, the actual stock, still a good bet after the wildest month memory chips have had in years? We're recording this as of July 30th, 2026, with the sector in the middle of a real, live sell-off. So nothing here is a victory lap. Let's get into it. Here's the shape of what's ahead, because this is genuinely two stories stitched together. Part 1, 8 chapters, is the war. Why memory suddenly became the most contested material in tech, where China's NAND and DRAM challengers are closing the gap faster than anyone expected a year ago, where the gap still holds, that's high bandwidth memory, and how sanctions are working, leaking, and getting rewritten in real time. Part 2, 14 chapters, flips the lens on a Micron itself as a business. Its history, how it actually makes money, what the numbers say after an extraordinary 2 years, and 3 honest price scenarios for where this goes from here, including through the sell-off happening as we speak. Think of Part 1 as why this company matters, and Part 2 as what it's actually worth. Let's start with the war. Quick housekeeping before we go further. Everything here is educational and informational, not financial, investment, legal, or tax advice, and I'm not a licensed advisor. There's no buy, sell, or hold rating anywhere in this video, and no price target you should trust blindly, especially not right now, with memory stocks moving double digits in a single session. Investing carries real risk, including loss of principal. Third-party data is used under fair use for commentary and analysis. My job for the next while is to hand you the clearest picture I can build. Your job is your own homework before you act on any of it. Now, let's talk about chips. Before we talk about who's winning, we need to talk about what's actually being fought over. DRAM, NAND, and this newer thing called HBM sit inside almost every piece of compute on Earth, but not every use gets treated equally anymore. Picture a factory that suddenly can't make enough of something for everyone, so it starts playing favorites. AI data centers sit at the very top of that list, because that's where the margin is. Cloud and enterprise servers are right behind. Below that, it gets squeezed. Smartphones need more memory than ever for on-device AI, but they're now competing with data centers for the same wafers and losing. PCs are in the same boat. Prices climbing even as shipments fall. Automotive is the interesting exception, insulated by long qualification cycles. Gaming consoles are at the back of the line, with manufacturers quietly cutting configurations to free up capacity for the more profitable stuff. The big idea: manufacturers are rationing supply, and AI jumped the queue. Everything else waits. So who is Micron, exactly? Based in Boise, Idaho, it's the only major U.S.-headquartered memory maker, competing globally against Samsung and SK Hynix inside one of the most capital-intensive, consolidated industries that exists. It makes 3 things, and the mix tells the story. DRAM, the working memory your computer uses for active tasks, is roughly 70% of revenue, increasingly pulled by data centers, because AI servers need far more memory per machine than anything that came before. NAND, the flash storage inside SSDs and phones, is about 20%, and Micron has been deliberately steering that business away from low-margin consumer products toward enterprise and AI-grade storage. And then there's the one everyone's obsessed with, HBM, high-bandwidth memory. Just over 10% of revenue today, but rising fast, and functionally the bottleneck product of the entire AI industry. Stacked memory sitting directly beside the GPU, sold out through 2027. Here's the fact that matters more than almost anything else in this video. There are only 3 companies on the planet that can make HBM at real scale. Micron, Samsung, and SK Hynix. That's the entire club. Before we go further, it's worth separating 3 things people constantly lump together. DRAM is working memory. NAND is storage memory. HBM is stacked DRAM bonded directly onto the compute package for extreme bandwidth, the AI-specific one. China's position looks completely different in each. In DRAM, CXMT holds a small slice of the global market by revenue, but its wafer capacity is closing in on Micron's, a meaningful, narrowing gap. In NAND, YMTC has essentially caught up to Micron on headline share, a narrow gap that keeps closing. In HBM, China's leading challenger is still years behind, with yields reportedly nowhere near production grade. Keep these three separate as we go. Conflating them, treating China as catching up as one uniform story, is where most hot takes on this topic go wrong. Here's the honest headline, and it hasn't really changed even with everything that's happened this month. This is not a story with a single winner. China is closing the gap far faster in commodity memory than most narratives from a year or two ago assumed, and it's still years behind in the highest value segment. Both things are true at once. NAND is converging fast. YMTC has essentially caught Micron on headline share. DRAM is the bigger surprise of 2026. China's CXMT just pulled off the largest Chinese semiconductor listing ever, even though its actual global share is still modest. HBM remains a wide gap. That's where Micron's value and its stock's recent pain are both concentrated. And sanctions, while real, are leakier than most people assume, with active lobbying right now to loosen them further. We'll show you exactly where all of this stands. Let's start with the clearest technical measuring stick, NAND layer count. YMTC's stacking architecture has closed most of the process node distance that used to separate it from the leaders. Micron currently ships at 232 layers. YMTC has pushed to 270. Samsung sits at 286. SK Hynix leads at 321. That puts YMTC ahead of Micron's shipping node and within a single generation of Samsung and SK Hynix. Genuinely remarkable for a company that didn't exist 15 years ago. Its roadmap doesn't slow down either. A roughly 300-layer generation targeted for this year, 400 layers by 2027, and 500 to 600-layer designs on the books for the end of the decade. One data point says more than the roadmap. Though, earlier this year, Samsung licensed elements of YMTC's own stacking patent portfolio for its next-generation NAND. That's the first time a reverse license has flowed from a Chinese memory vendor to a global leader. Sit with that for a second. Now the segment where the gap genuinely holds, DRAM and HBM. General-purpose DRAM sits at roughly a 2 to 3 year technology gap. General-purpose NAND is down to about 1 generation. High-bandwidth memory is a different animal entirely, 5+ years, and the reason is that HBM isn't really a process node race. It requires advanced logic design plus through-silicon via packaging expertise, not just cell density. SK Hynix is already shipping HBM4 in volume. China's leading DRAM challenger is only just entering HBM3, roughly 2 generations behind. Export controls target HBM and advanced packaging tools most directly, which reinforces that gap deliberately. And the money backs up why this segment matters most. Micron guides to a $100 billion HBM market by 2028, growing around 40% a year. The single segment the company is defending hardest, and the one investors are watching most closely through this month's volatility. Here's the fastest moving number in this entire story. A year ago, YMTC held 8% of global NAND shipment share. Today, it's at 13, nearly doubling in 4 quarters, and now sitting within a single point of Micron itself. Samsung still leads comfortably at the high 20s. SanDisk sits alongside YMTC in the low teens, and the other category, smaller players, has been shrinking as YMTC absorbs share. YMTC's own revenue growth over that stretch, roughly 445% year over year, the fastest of any major NAND producer on the planet. Industry reporting has YMTC on a path to become the 3rd largest global NAND producer once its newest Wuhan fab is fully ramped, possibly by the second half of this year. Read that headline carefully, though. Some of that opening exists because Micron chose to exit the low-margin consumer SSD business, not purely because YMTC out-executed head-to-head. Both things can be true. So how are export controls actually working? Short answer, they're a redirect, not a stop. They bite hardest on advanced lithography and packaging tools, the machines needed to reach the frontier, and on HBM and leading-edge logic co-integration specifically. Equipment servicing and software updates face tightened licensing too, but China adapts around every one of those pressure points. State-directed capital isn't profit-constrained, so funds keep flowing regardless of near-term returns. Legacy node tools plus architectural workarounds. Stacking is the best example. Substitute for equipment China can't legally buy. And domestic toolmakers are scaling in parallel to reduce that dependency altogether. The net effect so far, Chinese memory output stays overwhelmingly domestic, which limits direct global share loss for now. Though PC brands like Corsair, HP, and Dell are already quietly qualifying China-made DDR5 for some products. What's forming underneath all of this is a widening two-track memory market, a global spec supply chain, and a China spec one running in parallel. Why does any of this matter right now, urgently, rather than as a slow-burn industry story? Because AI accelerators are increasingly bottlenecked by memory bandwidth, not raw compute. That single fact pulled DRAM and NAND out of the boring commodity cycle story and into the same strategic category as advanced logic and lithography. Picture the stack. GPU or accelerator silicon from NVIDIA or AMD sits at the center, with an HBM stack built by Micron, SK Hynix, or Samsung, bonded directly onto the compute package. Micron now forecasts that HBM market growing about 40% a year through 2028, from around $35 billion in 2025 to $100 billion, a milestone it now expects 2 years earlier than it previously guided. Despite that growth, Micron says it can only fill somewhere between half and two-thirds of core customer demand, even after locking in pricing and volume for its entire 2026 HBM supply. And NAND prices were tracking 70 to 75% quarter-over-quarter increases earlier this year, for the first time outpacing DRAM in this cycle. This is not a slow year for memory. It's the tightest supply market in years, even with stocks falling. Let's zoom into NAND specifically, because this is where the story has moved fastest. Global NAND revenue hit a record this year on AI-driven demand, and YMTC was the single biggest beneficiary of that surge. Look at the share breakdown. Samsung leads, SK Hynix and Kioxia sit just behind it, and then there's essentially a three-way tie in the low teens between YMTC, Micron, and SanDisk. That's the headline. YMTC has genuinely caught Micron on NAND market share. Read it with some caution in both directions, though. On one hand, YMTC's newest 294-layer 3D NAND has narrowed the layer count gap with Samsung to single digits. Its yield and process stability are reportedly approaching leading suppliers, and it just launched a consumer SSD brand directly challenging Samsung and SK Hynix on their own home turf in South Korea. On the other hand, some of that opening exists precisely because Micron voluntarily exited the consumer SSD business to focus on higher-margin enterprise and AI products. Part of YMTC's gain is Micron choosing not to compete in that segment anymore, not purely YMTC beating Micron head-to-head. Now here's the part one think most coverage was underweighting even a few weeks ago, CXMT and DRAM. This is no longer a company most investors can afford to treat as a footnote. In late July, CXMT completed the largest ever mainland listing by a Chinese semiconductor company, an $8.5 billion IPO valuing it around $85 billion. And on its Shanghai debut, the stock opened nearly 5 times above its offer price. Samsung and SK Hynix both sold off in sympathy the same day, and so did Micron, which briefly lost its trillion-dollar market cap on the news. On raw capacity, CXMT is genuinely closing in on Micron. One bottom-up estimate has it finishing this year at roughly 350,000 wafer starts per month, just 25,000 short of Micron's own pace. But capacity is not the same thing as market share. CXMT's actual share of the global DRAM market, even after a real jump this year, is still in the high single digits. Micron, SK Hynix, and Samsung together still control the overwhelming majority. And on cost, CXMT still runs meaningfully behind the incumbents. its die sizes are larger, its yields fall short of industry standard levels. And in China's own retail market this July, its memory modules actually sold at a slight premium to Samsung and SK Hynix equivalents, not a discount. This is a company accelerating fast from a small base. That's different from a company about to overtake the leaders. Now the segment where the gap is genuinely wide, HBM. Micron is already in high-volume production of HBM4, pin speeds above 11 gigabits per second, bandwidth above 2.8 terabytes per second, and it's designed in NVIDIA's Vera Rubin platform. HBM4E, the next generation, is already ramping toward 2027 on Micron's newest DRAM node. China's leading DRAM challenger, by contrast, is only entering mass production of HBM2E, a generation South Korean makers reached around 2020. Outside analyst estimates put the gap at roughly 3 to 4 years, with reported yields still in the low single digits as of mid-2026. That's the number that matters most here, not layer counts or wafer starts, but whether a chip actually comes off the line working. This is the moat that's genuinely holding, and it's why, even in a month where the stock has fallen hard, nobody serious is arguing China is close to displacing Micron in the segment that carries the highest margin. Zoom out to the competitive map, and you get a genuine three-player DRAM oligopoly, each with a different edge. Samsung leads DRAM by revenue with the broadest customer base and the deepest balance sheet, and is racing to qualify HBM4. SK Hynix is the clear HBM leader, first to mass-produce HBM3 and HBM3E, NVIDIA's largest HBM4 allocation partner, and freshly listed on the NASDAQ earlier this month in one of the largest U.S. IPOs by a foreign company. Micron is the number 3 global player and the only U.S. option, with HBM4 already shipping for Vera Rubin and revenue visibility backed by strategic customer agreements. And then there's China's CXMT and YMTC together, still a modest single-digit to low double-digit slice of the pie, growing fast on state-backed capacity, but still trailing badly on yield and performance, especially in HBM, where thermal and speed hurdles remain real. On NAND specifically, 5 companies now control the overwhelming majority of global revenue, with Micron's data center SSD business hitting record share on its newest NAND node. The single biggest competitive risk flagged by analysts right now isn't China at all. It's SK Hynix, freshly capitalized from its own listing, potentially capturing the lion's share of NVIDIA's next-generation HBM allocation. This is the part of the story that reaches everyone, not just investors. Tim Cook's "never seen anything like it in 40 years" line was about this exact shortage. DRAM and NAND contract prices jumped somewhere near 90 to 95% quarter over quarter earlier this year, and consumer memory inflation has topped 300% over the full year. Apple already raised prices on Mac, iPad, Apple TV, and even HomePod by anywhere from $100 to $500. And a new iPhone lineup is expected to carry meaningfully higher prices too, purely to hold margin against the memory bill. Why can't Apple just absorb it the way it usually does? Because the headroom it had quietly built in, adjusting storage tiers, eating some cost, is now exhausted, and because on-device AI features actually need more memory per device, not less, so demand and cost are rising together. It's not just Apple, either. Microsoft cut the 2 terabyte Xbox configuration entirely and raised prices, and PC makers across the board are shipping smaller base configurations at higher prices. Here's the read-through from Micron, the company. This is direct evidence of real pricing power. OEMs are absorbing triple-digit percentage cost increases rather than losing supply, which confirms Micron's own disclosure that it can only fill about half to 2/3 of core demand. This is a genuine binding shortage, not manufactured scarcity. The risk, of course, is that sustained price pain eventually dampens the very demand that's driving it. Let's walk the actual timeline of Micron's relationship with China, because it's been a steady one-way retreat. In 2023, China's cyberspace regulator opened a security review of Micron's products, then banned them outright from the country's critical infrastructure, widely read as retaliation for U.S. export controls, including the ones placed on YMTC. Given all that uncertainty, I'm not going to hand you one forecast. I'll give you 3 scenarios worth holding at once. In the base case, controlled competition continues. Sanctions hold, trade continues, and China progresses gradually within current constraints. The likely winners are Micron and SK Hynix, with higher margins persisting for the leading suppliers. In the bullish China case, YMTC and CXMT reach genuinely competitive yields at real scale and take domestic share rapidly, putting pricing pressure on global NAND and commodity DRAM specifically. And in the tail risk case, a Taiwan crisis or a sharp technology decoupling disrupts the broader supply chain. And in that world, there's no clear winner, just a supply shock and extreme volatility across the entire industry, memory and otherwise. Weight these however you want, but don't plan around only one of them, especially not right now, with the sector already this jumpy. So where could Chinese memory share actually land by 2030? Treat this as an illustrative range, not a formal forecast. The shape of the curves is the takeaway, not the exact numbers. All 3 scenarios start from roughly the same place today, around 3%. In the bear case, sanctions bite harder and yields stay weak, and China ends the decade as a mid-single-digit player, around 7%. In the base case, gradual convergence continues at roughly today's pace, landing in the low double digits, around 12%. In the bull case, a genuine breakthrough in yields and packaging gets China to somewhere near 18%, meaningful, but still well short of parity. Notice what's consistent across every one of these paths. Outright parity with Micron by 2030 isn't the modal outcome in any of them, even the optimistic one. The other half of this story is that Washington isn't only restricting China's supply, it's actively subsidizing its own, and Micron has been pulling its own timeline forward as urgency has grown. The CHIPS Act plus direct customer demand is financing a multi-site U.S. and allied build-out that's moved up more than once already. This year, fiscal year CAPEX was raised above $25 billion, driven by HBM and DRAM investment, with a second Idaho fab breaking ground and a first New York fab groundbreaking underway. By the middle of next year, the first Idaho fab is targeted to produce its first wafers, pulled in from a prior second half 2027 target. Later in 2027, a Singapore advanced packaging facility starts contributing meaningfully to HBM supply. By the end of 2028, the second Idaho fab comes online. And from 2030 onward, the New York fabs begin supplying volume, anchoring a 20-year expansion plan. Why does concrete and steel matter as a signal? Because it says 3 things at once. To China, that the U.S. intends to keep advanced memory manufacturing onshore. To hyperscaler customers, that supply will be more secure. And to investors, that memory is now treated as strategic infrastructure, not a pure commodity. So how do export controls actually work mechanically? Washington's approach targets the tools and inputs needed to reach the technology frontier, not the finished chips themselves. A rule from late 2024 specifically targeted HBM and added well over 140 Chinese chip manufacturers and toolmakers to the restricted list. For choke points matter most. First, EUV and advanced lithography. ASML's extreme ultraviolet tools are essential for the most advanced logic, and memory is touched by the broader tooling net, even though it's less directly EUV dependent. Second, deposition and etch. Equipment from Applied Materials, Lam Research, and KLA that's core to building the 3-dimensional structures modern NAND and DRAM require. Third, advanced packaging through silicon via bonding and interposer tools, which is increasingly the actual bottleneck for HBM specifically, and exactly where China's yield problems concentrate. And fourth, EDA design software from Synopsys and Cadence, which sits upstream of literally everything else on this list. Control any one choke point well enough, and you slow the whole stack down. Here's where I want to be fully honest, because this is the part most decks on this topic skip entirely. Sanctions enforcement isn't a clean, static wall. It's been contested from the start, and it's being actively contested right now in real time. When that 2024 HBM-focused rule was introduced, regulators actually placed CXMT on a narrower restriction, one that only barred the U.S. Department of War from dealing with it, reportedly after extensive lobbying tied to a Japanese equipment maker. And as of this July, the Financial Times reported that Apple has begun qualifying CXMT's mobile DRAM for China market devices, while simultaneously lobbying Washington against putting CXMT on the full entity list, a genuinely awkward position for a major U.S. company to be in publicly. There's also a proposed law, the Match Act, that would apply entity list-style restrictions covering servicing and technical support, not just new equipment sales, directly to CXMT, YMTC, and several other named Chinese facilities. It's cleared committee, but its final passage remains genuinely uncertain, and I'd rather tell you that plainly than pretend I know the outcome. The paradox underneath all of this: sanctions slow China down in the short term through delayed tools, lower yields, and higher costs, but they also motivate a stronger long-term response in heavier state subsidies, cheap financing, and aggressive talent recruitment. Both effects are running simultaneously, and investors need to track both. So, the honest answer to "Can China catch up?" Part 1's closing thought. Can YMTC catch NAND? Largely, yes, it already has on headline share. The remaining question is whether it can sustain yield and margin at scale under continued export controls. Can CXMT catch DRAM? It's converging faster than expected on raw capacity, and it just proved it can raise real outside capital doing it, but it's still a modest share player on actual global revenue today. Watch the gap between wafer scale and real share. That gap is doing most of the storytelling right now. Can China catch HBM? Unlikely this decade at the frontier. This is the segment where Micron's moat is real and where the technology and packaging gap is widest. And does China replace Micron? No evidence points that way. The far more likely outcome is a bifurcated market. China dominant in commodity memory, incumbents dominant in AI-grade memory. What to watch going forward? HBM revenue share, DRAM, and NAND contract pricing, Chinese yield data as it actually becomes available, entity list changes, and Micron's own gross margin trend. Those 5 data points will tell you which scenario is playing out faster than any single headline will. One more way to organize all of this: mapping likelihood against impact on Micron's competitive position. In the high likelihood, high impact box sit 2 things worth watching closely. Chinese memory eventually being exported meaningfully beyond its domestic market, and China restricting rare earth or specialty gas exports as retaliatory leverage. In high likelihood, lower impact territory, continued capacity expansion funded by public listings, CXMT's own IPO being the live example. In low likelihood, high impact territory, a further meaningful tightening of U.S. export controls. And in low likelihood, low impact territory, CHIPS Act funding being politically revisited. Of those, 3 deserve the closest attention. Export destination shift. If Chinese producers begin exporting meaningfully outside China, global pricing and share dynamics reprice quickly. Input material leverage. China's control over rare earths and specialty gases is a real retaliatory lever against further U.S. controls. And capital markets access. A public listing, which CXMT has now actually completed, opens a non-state funding channel that can accelerate capacity beyond what state subsidies alone would support. Let's put the 3 long-run scenarios side by side one more time, because they're the cleanest lens for thinking past this month's noise. Bear case: China exports globally. China lifts its domestic-only constraint and exports competitively priced NAND and DRAM at scale, compressing global pricing power for Samsung, SK Hynix, and Micron alike. Micron's HBM franchise partially insulates margins, but merchant DRAM and NAND share erodes. Base case: bifurcated market persists. Chinese memory stays largely domestic. The global merchant market stays led by the incumbents. The HBM gap persists through the decade, and Micron's U.S. fabs ramp on their current schedule. Gradual, contained share drift of a few points a year in legacy NAND and DRAM. Bull case: policy plus tech moat hold. Export controls hold the HBM and advanced packaging line. China's leading edge stalls. Chips-backed capacity comes online on schedule, and Micron converts AI-driven HBM demand into durable share and margin expansion. This isn't a coin flip between three equally likely outcomes. It's a range to hold in your head while you watch which one the data actually confirms. That's the war. Now let's put on the equity research hat and ask the boring but essential question. Is Micron, the actual stock, still a good business to own, especially after a month where it's fallen hard alongside the rest of the sector? We'll go through company history, how it actually makes money, what the full financials say, the technology and manufacturing roadmap, the complete competitive landscape, the honest risk list, the investment thesis, valuation, and 3 genuinely updated price scenarios that account for where the stock trades today, not where it traded a month ago. Micron now sits at the intersection of 3 structural forces: AI-driven high-bandwidth memory demand, a decade-long onshoring build-out, and a global memory industry consolidating around 3 suppliers. The central strategic question for the rest of this video: can Micron's roughly $250 billion multi-country manufacturing build-out keep pace with sold-out HBM demand before Samsung and SK Hynix flood the market with new capacity, and before the current sell-off tells us something the fundamentals haven't yet? Here's the snapshot as it actually stands today, not a month ago. Micron's market cap has moved a great deal through this sell-off. It briefly crossed $1 trillion in May and has swung by hundreds of billions of dollars in both directions since. So treat any single-day figure as a snapshot of a genuinely volatile tape, rather than a fixed number. Fiscal 2025 revenue was $37.4 billion. The most recent quarter alone, fiscal third quarter, brought in $41.5 billion, up 346% year over year, a number that would have sounded like a typo 2 years ago. Guidance for the next quarter points to $50 billion in revenue and roughly 86% gross margin, which would both be company records if hit. The company has built roughly $100 billion of contracted backlog through its strategic customer agreements. Against all that, a 52-week range that's been genuinely wild, reflecting a market that can't decide whether this is a durable AI infrastructure story or a classic memory cycle about to turn. Both readings are in play at once, and that tension is exactly what the rest of this section works through. Nearly 50 years of history sit behind this moment. Micron was founded in 1978 by 4 engineers working out of a Boise dental office basement, funded by a $1 million bet from potato magnate J.R. Simplot, genuinely one of the stranger origin stories in American tech. It went public on the NASDAQ in 1984, shipping the world's smallest 256 kilobit DRAM chip at the time. In 2013, it acquired Elpida Memory in Japan, gaining the Hiroshima fab and a real jump in DRAM scale. In 2022, riding the CHIPS Act tailwind, it announced a multi-decade plan for new fabs in Idaho and New York. By early 2024, HBM4E was ramping into volume, and Micron became a core AI memory supplier for NVIDIA's platforms. It broke ground on the first of 4 planned megafabs in Clay, New York, up to $100 billion committed there alone, and crossed $1 trillion in market capitalization in May of this year amid surging HBM demand, before reporting a genuinely blowout fiscal third quarter in June. What's been built along the way is hard for a new entrant to replicate at any speed. A roughly $250 billion U.S. manufacturing commitment, over 60,000 patents of deep process IP, and the simple fact of being the only U.S. memory champion left standing, with federal onshoring policy squarely behind it. So how does the money actually flow through the company? For business units, 1 manufacturing engine, 3 underlying technologies. Compared to the old memory business model, undifferentiated spot pricing, brutal boom-bust cycles, almost no customer lock-in, and Micron's current setup looks genuinely different. HBM leadership backed by long-term customer agreements, running at a trailing gross margin north of 70%. The cloud memory unit, built around HBM for AI accelerators, is the fastest-growing piece, with global HBM share roughly doubling over the past year. Core data center, covering high-capacity server DRAM and enterprise SSDs, alone brought in $25 billion of revenue in a single recent quarter. Mobile and client, The largest unit by volume, more mature in its growth profile, supplies the LPDDR5X memory going into smartphones and PCs. In automotive and embedded, the smallest but stickiest unit runs on long-term supply agreements with Ford and GM out of a dedicated Virginia fab. The gap Micron fills in the market. It's the only U.S.-headquartered supplier combining real HBM scale with the policy tailwind of onshoring support, a combination none of its rivals can fully match. Zoom out to the full market, and the imbalance becomes obvious. Roughly 70% of memory output is now flowing to data centers and AI infrastructure, leaving just 30% for smartphones, PCs, and every other device combined. Global drum industry revenue nearly doubled quarter over quarter earlier this year, hitting a record high driven by rising prices and surging HBM sales. On the demand side, a single large language model training run can require anywhere from 10,000 to over 100,000 GPUs, and every one of them needs HBM. Enterprise AI deployments have roughly tripled in the past couple of years. On the supply side, Samsung, SK Hynix, and Micron are all reallocating cleanroom capacity toward high-margin HBM, leaving less for conventional DRAM and NAND, and the new fabs that would relieve that pressure don't reach real volume until 2027 through 2030. That's the core mechanic behind everything else in this video. The shortage isn't seasonal, it's structural, and it's expected to persist well beyond next year, even as memory stock prices whipsaw on sentiment in the meantime. It's worth pausing on one thing the headlines tend to flatten. This quarter's strength wasn't just an HBM story. All four business units posted record revenue and margins in the same quarter, a broader-based beat than any single product line could deliver alone. Cloud memory brought in the largest dollar figure, an 83% gross margin. But core data center and mobile and client both matched or exceeded that dollar figure at 87% margins each. Automotive and embedded, the smallest unit, still ran a healthy 79% margin. Why this matters? The market narrative is dominated by HBM and cloud memory specifically, but the evidence here is that the pricing tailwind is genuinely industry-wide right now, not concentrated in one hot product line, which is either very reassuring because the strength is broad or slightly more concerning because a downturn wouldn't be contained to one segment either. Given everything happening in the stock this month, it's worth running an honest stress test. What happens to Micron's numbers if pricing actually normalizes? At the current run rate embedded in guidance, gross margin sits around 86%. A mild normalization, pricing down 5 to 10% quarter over quarter, still leaves margins in the high 70s, a genuine soft landing from peak pricing. A moderate correction, down 15 to 20%, pulls margins back toward the low to mid-60s, roughly where the prior cycle peaked in 2018, and CapEx plans would likely hold near term. A severe reversal, the 2022 to 2023 style collapse, would take margins down into the 20s or even single digits, which is not a hypothetical scenario. It happened just 3 years ago. Three things temper how much comfort to take from the strategic customer agreements here. Their price protection isn't absolute, since a portion of committed volume still references prevailing market indices. The same fixed cost base that lifted margins from 25 to 85% on the way up would compress them just as fast on the way down, and history offers a real precedent. Non-GAAP gross margin fell to roughly break-even within 2 quarters of the last cycle's peak. That's the honest tail risk sitting underneath this month's price action. Now, the full financial picture, and it is genuinely one of the sharpest inflections in memory industry history. Fiscal 2023 closed with a $5.8 billion net loss. The trailing 12 months through this past quarter show $50.5 billion of net income. Trailing revenue sits at $90.3 billion, up 167% year over year. The most recent single quarter alone was $41.5 billion, up 346%. Trailing gross margin has climbed to 72.6% versus just under 40% a year prior. Operating cash flow over the trailing year, $51.4 billion. Free cash flow, $26.2 billion, against just $1.7 billion the year before. Walk the full arc year by year from a loss in fiscal 2023 to a small profit in 2024 to $8.5 billion in 2025 to this trailing figure. And the quarterly revenue chart looks less like a normal ramp and more like a step function, roughly doubling or better in back-to-back quarters through the first half of this year. That's the fundamental backdrop the current stock volatility is trading against. Genuinely record numbers, meeting genuine skepticism about how long they can last. Here's what's actually in the pipeline behind those numbers. HBM4, based on Micron's 1-beta node, is already in high-volume shipments to its lead customer, with qualification samples out to others. HBM4E, the next step up, uses a custom logic die built with TSMC and is targeting volume production in calendar 2027. The 1-gamma DRAM node, Micron's newest, built on EUV lithography, shipped first in 2025 and is expected to become the company's largest volume node by the middle of this year, feeding servers, PCs, mobile, and automotive alike. On the NAND side, the G9 generation is already in high-volume production for PCIe Gen 6 SSDs, targeting a majority of shipped bits by mid-2026. Further out, 256GB DDR5 server modules using 3D die stacking are sampling now for AI servers. A 245TB enterprise SSD has already begun shipping to hyperscale data centers, and Micron has even sampled automotive-grade 1-gamma memory to a robotaxi customer, a small but telling sign of where memory demand is headed next, well beyond phones and PCs. The physical bet behind all of this, roughly $250 billion committed across a multi-country build-out targeted through 2035. In Boise, Idaho, headquarters, 2 new leading-edge fabs are under construction, co-located with R&D, targeting first production around mid-2027. In Clay, New York, the first of up to 4 planned megafabs broke ground in January this year, with up to $100 billion committed and the first fab targeted around 2030. Manassas, Virginia is being expanded for automotive and defense-grade memory, targeting qualified production by the end of this year. Overseas, the Hiroshima, Japan site, Micron's original Elpida acquisition, is being expanded specifically for HBM, with equipment installation targeted for the second half of 2028. A new Taiwan site, acquired earlier this year, adds DRAM and HBM capacity with shipments expected from fiscal 2028. And in Sanand, India, Micron opened the country's first commercial chip site this past March, over 500,000 square feet of cleanroom space. The honest risk sitting on top of all of this: export control exposure, tariff policy uncertainty, a genuine subsidy race with Japan, Taiwan, and Korea, and the simple logistics of water, power, and permitting across 5 countries running in parallel. Zooming back out to how Micron actually stacks up against its 2 real rivals. Micron, roughly $1 trillion market cap at its recent peak, low 20% DRAM share, and HBM share that's roughly doubled over the past year to the low 20%, the fastest gain of the 3 suppliers. SK Hynix, similarly large, high 20% DRAM share, and the clear HBM leader by a wide margin, thanks to NVIDIA's largest allocation and a first-mover advantage in HBM3 and HBM4E, reinforced by fresh capital from its own July NASDAQ listing. Samsung, the largest DRAM maker outright, with the deepest balance sheet of the 3, currently working to qualify HBM4 and close the gap. China's CXMT and YMTC together sit in the high single digits and rising, on the back of real state-backed capacity growth, but still trail meaningfully on yield and performance, particularly in HBM specifically. The key competitive insight for Micron: it's sold out of 2026 HBM capacity alongside its rivals, meaning pricing power sits firmly with suppliers for now, and as the only US-based major producer, it gets an onshoring policy tailwind that neither Samsung nor SK Hynix has domestically. Now the honest risk list, and given the month the stock has just had, this section deserves real weight rather than a token mention. At the top, memory cycle peak risk. Several analysts already expected margins and earnings to peak sometime in 2026 or early 2027, and the current sell-off is at least partly the market pricing that expectation in early. Right alongside it, competitor capacity flood, Samsung and SK Hynix are both scaling aggressively. And if HBM4 supply floods the market after 2027, pricing and margins could compress sharply. High priority risks below that: execution risk on the full $250 billion CAPEX program, being built across 5 countries simultaneously, and customer concentration, since revenue increasingly sits with a small number of hyperscaler and AI counterparties. On valuations specifically, even after this month's pullback, the trailing multiple has re-rated meaningfully from where it sat a year ago, and the market's forward multiple still assumes near-peak margins persist, which is historically a fragile assumption in this industry. China export controls remain an industry-wide overhang rather than a Micron-specific one. And 2 watch items round out. The Taiwan campus sits inside one of the world's most geopolitically sensitive regions, and new fab ramps in Idaho and Taiwan both depend on securing water, power, and permitting on schedule. 3 things need to hold together all at once for the bull case to actually work, and this month is a live test of at least 2 of them. First, AI memory demand is structural, not just cyclical. If true, HBM4E and HBM4 capacity sold out through 2027 and 2028, 16 strategic customer agreements worth roughly $22 billion, and emerging demand from autonomous vehicles and humanoid robots all extend the runway for years. If false, if efficiency gains in AI training or inference meaningfully reduce memory intensity per task, the assumption of ever-rising memory content per system weakens, and that's exactly the fear currently driving the sell-off. Second, Micron can defend and grow its roughly 21% HBM share. If true, that share has already roughly doubled year over year, the fastest gain of the 3 suppliers, and the HBM4E collaboration with TSMC deepens customer stickiness. If false, SK Hynix's structural lead and deeper NVIDIA relationship hold, or Samsung's larger balance sheet lets it underprice to reclaim share once its own HBM4 fully qualifies. Third, the multi-region manufacturing build-out pays off before the cycle turns. If true, it's being funded largely from record operating cash flow rather than debt, backed by binding multi-year agreements. If false, CAPEX is heavily front-loaded while new fabs take years to ramp. And if the cycle turns before they're productive, Micron could be left holding expensive new capacity right as pricing falls, which is precisely the scenario this month's price action is starting to price in. On valuation, here's the honest picture even after the recent pullback. Micron's trailing multiple, based on fiscal 2025 earnings, sits meaningfully higher than its forward multiple based on this year's expected earnings, a steep gap that reflects the market's underlying bet on where the cycle actually sits. Compared to peers, SK Hynix, the HBM share leader, trades at a comparable forward range with its allocation advantage baked in. Samsung, with its far larger and more diversified base, trades at a mid-teens multiple. The broader semiconductor sector median sits well above all 3 memory names in the mid to high 20s. The key insight here: Micron trades at a real discount to both its own trailing multiple and the sector median, a pattern typical of cyclical stocks where the market prices in an eventual margin normalization rather than assuming today's record profitability holds forever. That gap is the market's way of signaling skepticism about durability. Whether that skepticism proves overly conservative or turns out to be exactly right depends almost entirely on how long the AI memory supercycle extends before Samsung and SK Hynix capacity genuinely catches up. And this month's volatility is the market actively repricing that very question in real time. So, 3 scenarios for where this actually goes from here. And I want to be direct that these need to be read against today's genuinely volatile tape, not a calm one. In the bear case, the memory cycle turns sooner than expected. AI infrastructure spending pauses or slows. HBM supply from Samsung and SK Hynix comes on faster than demand absorbs it. And NAND oversupply drags gross margins back toward the mid-teens to 20s, a real derating scenario, and the one this month's sell-off is partly pricing toward. In the base case, the current guidance largely holds. Revenue growth moderates from its recent extraordinary pace towards something still very strong by historical standards. Margins stabilize in the high 70s to mid-80s range, and the stock finds a floor once the market gets comfortable that this quarter's numbers aren't a one-off peak. In the bull case, HBM4 and HBM4E demand keeps outrunning supply through 2027. The chips-backed fabs come online on schedule. China's export control line holds on the highest value segment, and the multiple re-rates upward as the market starts treating AI memory less like a commodity and more like infrastructure. Wall Street's own read, even through this sell-off, remains net constructive. A majority of covering analysts still rate the stock a buy, but the range of price targets across those same analysts has widened considerably this month, which tells you plainly that this is genuinely contested among professionals, not settled. If you're tracking this stock through the current volatility, a handful of things matter more than the rest. On earnings, watch whether revenue actually lands near guidance, whether the roughly 86% gross margin guide holds or normalizes, and whether HBM4 and HBM4E mix and pricing keep holding up quarter over quarter. On technology and manufacturing, track HBM4E and TSMC custom logic die progress toward calendar 2027, whether the 1 gamma DRAM node hits its targeted volume share on schedule, and construction milestones at Boise, Clay, and Manassas specifically. On the regulatory side, watch China's export control status for advanced memory and HBM specifically, whether the Match Act actually becomes law, CHIPS Act disbursement, and any new tariff proposals touching semiconductors. And on the competitive side specifically, watch CXMT's next disclosed DRAM share number now that it's a public company with real reporting obligations, YMTC's progress toward its own stated NAND share targets, and any signal that Chinese memory is starting to move meaningfully beyond its domestic market. The single nearest term catalyst that matters most, the next quarterly earnings report, which will be the first real test of whether this month's sell-off was a healthy reset or the start of something the fundamentals haven't caught up to yet. So, the whole thing in a few sentences. Micron is the only U.S.-headquartered maker of DRAM, NAND, and HBM at real scale, riding a genuinely sold-out AI memory upcycle, while pouring roughly $250 billion over a decade in Idaho, New York, Japan, Taiwan, and India to defend and grow its position before the next memory downer eventually arrives. Because in this industry, it always eventually does. What makes it different this cycle? Unlike prior downturns, more than half of targeted revenue sits under multi-year strategic customer agreements rather than pure spot pricing, and it's the only major producer with a direct line to U.S. onshoring incentives. What we like, HBM share that's roughly doubled year over year, gross margins near record highs, a real contracted backlog, and cash flow that's largely self-funding an aggressive build-out rather than relying on debt. What worries us, and what this month has made impossible to ignore, sell-side analysts broadly agree memory margins look set to peak sometime around 2026 or 2027 as rivals add capacity. The CAPEX program carries real execution risk across 5 countries at once, and revenue is increasingly concentrated among a small number of AI customers. On the China question specifically, NAND has largely been caught. DRAM is converging faster than expected on capacity, even if not yet on share, and HBM remains the genuine, durable moat. This is a company with a real, hard-to-copy technological edge, moving through a real, uncomfortable moment of market doubt, and the next earnings report is likely to tell us a great deal about which story actually wins out. This isn't investment advice, and it isn't a rating. It's the clearest picture I could build as of the end of July 2026. Do your own research from here.